Hello, Zach here with Casual Conversation with Zack Scicluna. Hope you're doing well. I wanted to talk about a topic here today about the cost of homeownership. Some folks will say, hey, I want to get out of renting and I want to go buy instead and own a home and be my own landlord, or make my own rules, have whatever animals I want, things like that. And there's a couple dynamics I want to educate on in regards to homeownership. So most folks, when they buy a home, they definitely think, all right, I got to pay for all the utilities now. In most cases, they're familiar with that. They have renter's insurance. A lot of landlords require that. And so they're just basically trading one insurance for the other insurance. And when you're doing that, it's not bad to keep in mind additional things. So for example, your utilities, perfect, that's all great. You'll want to account for septic, sewer of some kind. Septic, it's going to be more of like every so many years you have to pay out of pocket for. Sewer, you're going to have to pay monthly for in most cases. Garbage, you're going to pay for monthly in most cases. There's very few properties that don't have some kind of public garbage collection service. That being said, I know some rural properties where that's the case, and then you actually have to go and either pay a service, so you have a dumpster on your property and they come out and pick it up, or you take it to a dump recyclology place of some kind. You'll have water, which is traditionally either a well or a pumped in source. So the pumped in sources, it'll be a water spigot you go and you turn off at the street or near the end of your home, and it's pressurized and you pay monthly for that. It tends to be based on like a volume of some kind. Or a measured unit that you'll pay for on that one, and again, monthly basis. So variables to take into account: is there a ton of grass? Is there a ton of landscaping you need to water? Is there fruit trees? Is there stuff like that you got to be aware of? And if you're coming from the renting world to here, some landlords actually pay for the water bill, and that's their way of keeping the landscaping going and things like that. Or they'll offer like a credit saying, we'll cover your water bill up to $50 or $70 a month. Anything beyond that is on you guys. When you're a homeowner, you cover the whole bill. So it's something to keep in mind that when you have the piped in water, the monthly bill, if you have a well, you won't have a monthly bill on that. The main cost of the well is the initial drilling of it. So if you're buying a home, it's already got a well in most cases, and you get to just enjoy the main cost being paid for already. That being said, we're not off the hook. We got to power the well. The well is kind of like, if you want to think of it, it's a pump. So it draws a lot of electricity. Anytime you turn the spigot on, your water starts coming out. So you're pulling water from the earth, and then you're also pulling current from your electrical lines. So you can watch your electric meter start rolling up. So some folks might see a higher electricity bill when you have a well versus if you have a piped in water. So there's a little bit of stuff to weigh out there. Something to keep in mind, some of the rural properties, you're almost, it's catch-22, but sometimes you're better off having the piped in water. And the reason I say that can sometimes be better is because if you've got the piped in water, that means you have a pressurized pipe in the street, which means you in turn technically should or likely have fire hydrants on your street or nearby, which helps with fire insurance. The next component, which we'll cover fire insurance in just a moment, but covering all the other utility bills, we've got electricity. One of the lending requirements in most cases, 95%, 99% of the deals, is you have to have some kind of guaranteed electrical source of some kind. You got to be tied to the grid. So if you see an off-grid home, it can be financed. Sometimes it gets really tricky. Talk to me in more detail. We'll get you exactly figure out what some options are. But traditionally speaking, most homes have an electric meter. The local areas, you've got Roseville Electric, you've got PG&E, you've got SMUD, you've got a whole slur of different micro electric companies that are powering the homes, and that's where you have the monthly cost. Most renters, you'll be familiar with paying an electric bill, as well as a gas bill of some kind. So if you have a gas stove, your oven, you turn it on, or you have a gas burning furnace of some kind, natural gas, that will be tied there. If you're in a rural property, you might have what's called a propane tank. Propane tanks, nice thing about that is you can fill the propane tank up when it's an off-season time, when gas is cheaper, and then you can use it when the rates are high, and then as gas prices lower, you fill back up. So it's just like filling up your car tank, except now your house has a fuel tank of some kind. Generators, a lot of the home generators, they either run off of gasoline from a gas pump, you have to 5-gallon barrel and you fill that into your generators. Larger ones, they'll run off a diesel, and then most commonly they run off of propane. So if you have propane on your home, you can actually easily tie into that and get a generator installed and really cut out that limbo of, hey, power's going out, I need to scramble and figure something out. So those are the dynamics. We've covered sewer, garbage, water, and electricity and gas. So now the other thing is going to be insurance. Folks don't always think of this. Insurance, if you're going from renting to owning, you're going to be having the dynamic of renter's insurance, which tends to be a lot less than homeowner's insurance. And the reason is because they're going to be covering liabilities, they're going to be covering the home, your personal property in the home. When you're a renter, they tend to just cover just your belongings, and if there's some kind of damage to the house, you have a little bit of coverage, but it's not to replace the whole structure. So there's this huge liability that's now there, and unfortunately when there's a liability, we got to pay for it as a end user consumer. So when you do the insurance, there's a lot of dynamics. It's not quite like car insurance, but it is similarly complicated. There's a couple different branches of insurance, and I have a number of great insurance brokers. If you need a recommendation, I'm happy to pass their info along. They do wonderful work, and they're able to, again, price out a bunch of different companies and make sure you are getting a good rate. When you live in a rural property, sometimes you'll get a letter in the mail that says, hey, you've been dropped. That's something that happens. And with the wildfire scenario where this is being recorded in the state of California, on the West Coast, but very common. And when you have that common variable, the insurance companies start to boost up the rates because there's a liability now. They're seeing that there are more wildfires, there's more risks, and they're in the business of making it's a gamble. Their insurance companies, that's how they make their money, is no claims, and that's how they get to have their proceeds. Well, when you have fire insurance, it can raise the prices pretty drastically. I've seen estimates up to $12,000 a year. It's $1,000 a month for insurance. If you're renting, if you're a renter, you're like $100 a month if you're lucky. And the average home in a residential, non-risk, non-flood, no FEMA hazard risk areas, they're probably around the $150, $200 a month. Those are components you got to take into account. Insurance, which is huge, and then you've got the dynamic of, who's going to pay that? And in most cases, if you're doing a traditional mortgage, your insurance is actually going to be rolled into your mortgage or your loan. It's the way they write it. So what ends up happening is you have, your full mortgage payment, what you feel out of your pocket. Well, 60-70% of that is straight to the banks to take care of the bank's dynamic. A sliver of it will be towards taxes, and the other sliver will be towards insurance. And sometimes there's even another sliver, which is for the mortgage insurance. So depending how much down payment you do, you've got that other cost. Mortgage insurance, it's a bummer because you don't ever see any value from it on your end. It's a protective component for the banks. There's nothing really for us as the end user to benefit from it. It's not equity. It's not an asset we're getting anything out of. It's protection for the banks. Keep all those in mind. The insurance is huge. It's a big difference. Again, the insurance broker is going to help us pinpoint who's the cheapest rate for it. And you can keep your car insurance, folks, with whoever you have. That's great. And then you can have your home separate, but sometimes you get the whole bundle package deal. It all varies, but an insurance broker is going to help you figure out exactly the best plan of attack, the best guidance of it. So again, I've got contacts for you there on that side of it. And so those are the biggest differences of home ownership and renting. Another dynamic, the taxes, it's rolled into the mortgage, so you don't always feel that. But there's things called HOAs, Mellorews, specialty taxes. There's a lot of different names for them, but they're all the same thing of it's a tax coming out of your pocket for some kind of government-funded benefit of some kind. So in this case, when you're looking at an HOA, you'll see those real commonly in condos or townhomes, communities like that where there's a management association of some kind where they are the ruling power. You can't paint, you can't change the color of the house, you can't do this to the exterior, things like that. That'll be an HOA. So they'll have stricter guidelines of rules. You can sometimes get them in the rural properties, but they tends to be pretty uncommon. What you will see though is CC&Rs. CC&Rs can be tricky. The nice thing about CC&Rs, you usually don't have a cost for them. So when you don't have a cost for them, all that's really there for, the CC&Rs, is just making sure that people are using the land that's in that area for a given purpose. And so that's something where if you're going from renting to owning, sometimes an HOA or a CC&R can actually feel just like a landlord. You can't have a certain type of breed, you can't do fences, or you can't park cars on the street overnight, or you can't park cars on the street at all. Those are some of the guidelines of what an HOA can say. So in some people's minds, they will never do an HOA because of the dynamic of it's a landlord in some shapes or form. The benefits to them, it really can keep up the neighborhood pretty nicely. You have people with common mindsets that move to a given area and they want the neighborhood to be as nice as physically possible with littlest disturbances as possible, and that's who tend to mesh really well in those communities is folks who do align with those HOA guidelines. So HOAs are for some folks, but not for others. So it's something to talk about. I'm happy to guide you through the process if we ever come across them. But that's something, again, keep it top of mind. Specialty taxes, you'll see those with like newer construction areas. What happens is the infrastructure that's approved by the county or the city, whoever, they say, hey, builder, you have to pass this cost onto a new owner. And that new owner is basically paying for the building up of the surrounding infrastructure. So if you have a brand new neighborhood in the middle of just all these fields and there's nothing around it, no new school, no nothing, what's likely going to happen is there's likely going to be a specialty tax. And that specialty tax is so you guys in that region can benefit from either a new school that could be built over the next 5 to 10 years, or a new firehouse, or new just infrastructure in that sense for the public, you guys, the public that own in that region. So specialty taxes, they'll have an expiration on them. Well, again, as we run through these are things that you tend to find out either right out the gate when you're talking to a builder, or in the inspection period if it's a pre-owned home, 3-4 years old or whatnot. And again, I can help you understand those, go into more detail, make sure you're making a wise decision. I love talking to folks, and sometimes not knowing everything in the room is huge, and not always, being able to talk to somebody who comes from a different angle. And so I recently had that with a client. We were at some new homes looking, and I really encourage folks to think of HOAs at, what's the cost of it in like a 5-year, realm. And this client actually pointed out a really valid point, because I was looking at 5 to 10, which tends to be the most long-term that folks ever tend to think. And he actually said, hey, well, on the 30-year, it's actually a different dynamic. And in reality, it's really smart. If you're thinking long-term, if you're going to buy a house, and maybe you're going to buy a house and you're just going to hold on to it for a long time, when you buy that house, those HOAs add up. Those, the Mellorews, those add up cost-wise. And so if you figure it's $200 a month, 2 times 12, well, so let's see here, $2,400 a year, times that by 30, and it adds up really, really quick. And so one thing he was doing is he said, I actually would rather spend that, obviously you're paying right out the gate, but I'd rather spend that extra, 60 grand out the gate and not have to deal with HOAs or Mellorews. And that's technically going to be appreciation you're going to get, right? As you make your mortgage payments. So yeah, you're paying more, but you don't have that HOA that's kind of always going. There's always this running tab open. But when you buy no HOA, no Mellorews at that higher price point, by the time this gets up to here, this keeps going up and up and up and up. But this one just stays right where it was at when you bought it. There's no extra cost except just your local taxes, and you're building that equity. Because if you paid that amount at one point in time, someone eventually in the long term is likely going to pay that amount or more for it. Just kind of what happens, everything appreciates. Currently, that's how it goes. And yeah, so it's HOAs, Mellorews. Mellorews are going to be like an extra little city tax. There tends to be like a little bit of benefit, whether it's upkeeping parks or things like that, but they're going to be an additional tax for the more local region. And those are costs. That's on the tax dynamic of, again, your utilities, your insurance, taxes. That's homeownership versus renting. Renting, you just pay the bill, call if there's any issues. It can sometimes be nice to not have to deal with those extra little stressors. Another dynamic is repairs. Folks don't always think of that. Home ownership. We buy the home and we think it's going to last forever and you not have to do anything sometimes, but there are always little things that come up, whether it's a light switch that stops working, light bulbs, a couple light bulbs go out, things start adding up real quick. Your roof in 5 to 10 years, if you come into a house and the roof is 15 years old, traditional roof is lasting anywhere from like 30 to 50 years. 50 years if it's a higher quality roof. But most folks are coming into a roof that's a 30-year life roof. Those are the composite traditionally ones. And home with 10 to 15 year age approximation, because most folks don't know exactly when they replace the roof. And that means, yeah, within 5 to 10 years, you might be looking at that big bill. So depending where you're at in life, maybe things will get better for you. You're expecting increases in wages, things like that. Maybe that extra money, that cost won't hurt so bad. Another thing to keep in mind is HVAC and windows. Folks, windows not so much, but the HVAC, heater, AC, that's another big ticket item, and that can really make it pretty uncomfortable temperature-wise if it goes out. And if you're a renter, you call the landlord within a few days, they have somebody out there, and it's no sweat off your bill. It's just they paid for it, they took care of it. But if you're the homeowner, that could be a $10,000 to $15,000 bill that you're staring down the barrel of if that goes out in dead summer or the dead of winter and you need heat or you need cool air. So again, not to be scary, not to be off-putting, but just educational. Because again, this is casual conversation, and they're all dynamics of, whether you wanted to hear it or not, you gotta educate yourself so you can know that that's truly what's out there. Because again, it can totally stem the thought of which direction do you truly want to go. Is condo life more for you, where they buffer in all the exterior costs, roof and siding, and those dynamics? Is that more in line with what you're trying to do? Or is it something where, hey, you know what, I want to be totally away from all bills of all kinds, shapes and size. I want to do rural property. I don't want monthly utility bills from a water company or from a sewer company. And I want to get solar so I can lower my electricity costs. And so in reality, my overhead monthly costs are really low, traditionally operating speaking wise. And so you've got these big variables. And then there's the one right there as well that, hey, do I just want to rent? Am I not going to be somewhere for very long? Am I going to be somewhere for like a year to 2 years? Am I getting a promotion? Am I going to be jumping from one town to the next town, one company to the next company? You don't know. And if that's the case, it's probably worth renting. Because nothing worse than getting an asset in a town you might not be in, and the town might not be the best income provider, and you bought that, and now you're tied to that town and that asset. And sure, you can rent it, that's great and dandy. Just make sure you get the right connections, and I can help you think about all those processes of who you need to talk to, who you should have in a Rolodex, get things going. If you're going to step out of town and keep that going and have that revenue, that's huge. But again, those are the big differences of home ownership and renting. You've got some additional costs, but you are also building equity. And the equity component means it's a forced savings account or a forced retirement account, depending how you use that asset. When you're renting, it is money that you're giving to another individual to just reside in a home, and there's nothing wrong with that. There's a time and a place for it. One thing to keep in mind is some folks will be, they date each other, and they sometimes just want to jump right into home ownership, and sometimes that's a good idea, sometimes it's not a great idea, because if you don't stay together, now you have this other attachment that makes life a little tricky. And so, if you were dating someone and you want to test out, living with each other, maybe renting is the first best bet, and that way you don't have that home ownership hurdle unless one person can take the brunt of the financial component and is prepared for that. I recommend that discussion if that's something you're in the consideration of, because it's a tough one if something doesn't work out and you've got that. But renting, home ownership, great options. Both are great options. It's just a matter of what your personal unique goal is in life and what you're trying to achieve. Talk to me. I want to talk to you. I want to help you troubleshoot, give some extra ideas, be a little devil's advocate to your thought process, and make sure you're covering the T's and I's, because there are so many options, and every person's story is a little unique, and I'd be honored to help you with your story and help you achieve your upcoming goals. So thanks for tuning in to Casual Conversation with Zack Scicluna, myself. And please like, subscribe, share the video. If you know anybody that can benefit from this, please share it. As well, if you know of anyone that could use this information, or they might want to get information from me, please pass their info to me. I'd be honored to help. If you want to on our monthly magazine subscription, please reach out. I'd be honored to put you on there. No trouble to you. But again, thanks for tuning in. Stay well.